Good morning, everyone. Morena, Guangqi Fa Chai. Happy Chinese New Year. And I guess welcome to the very first update of 2025. I'll just take a couple of moments before jumping into the presentations with the presenters that you know about. First of all, just wanted to start by saying thank you very much for the support you showed us in 2024. I hope you got a bit of a break of some sort, and you're in the right place for reasonable weather. We are right back into it already, and if you're having a look at the top right portion of my Zoom background, one of the things that's coming later in the year is the renaming or rebranding to Amova, so you can see that branding in the top right corner. The other thing to look out for is the summit invites. So Wellington on the 18th of March and Auckland on the 19th of March. A couple more comments. Business is really well placed at the moment to deliver what all of our clients want, and importantly in the way that you want. Our strategy, our process, and our people are all set to focus on all of you in the year ahead. One last reminder, I can intermediate questions to the speakers. We've actually got a couple already logged with us that people wanted addressed, so we'll try and gather those up as we go through. Without any further delay then, let's hand over to friend, colleague and associate Andrew Hunt. The floor is yours, Andrew.
Good morning, and yeah, happy new year of all sorts. What a year I think it's going to be. It's a real year for economists. I think I can give you two scenarios. So on the left hand and the right hand could potentially be different. But I think we probably know what many of the problems are we're facing. And for the first part of the presentation, I think it's worth just recapping some of those. So it's trying to get the right screen. I think the features that defined really the last 25 years, 30 years, are perhaps reaching the end of their respective cycles. I don't think this is a new beginning, despite some of the political changes we've seen, but I think it's possibly the beginning of the end, as it were, for many of the cycles. And we really have to go back to the mid-90s, when the current world trading system was essentially created, WTO and all of that. And that involved putting together two economic systems that I think were fundamentally incompatible within the same trading system, namely North Asia's economic model that maximizes output and employment, whereas the West maximizes profits, maximizes consumption, cash flow, and is generally kind of, I say, consumer focused, whereas the North Asian model was very much supply side, output focused. Now, because the North Asian economies were attempting to maximize employment and output, they never and didn't worry too much about cash flow. In fact, they had a tame banking system, so they didn't have to worry about cash flow. Generally, the countries of North Asia, particularly thinking of China from 94 onwards when they did their big devaluation, were generally exporting deflation. Now, at the same time, the West was adopting inflation targeting, which actually is a Kiwi invention. It was the Reserve Bank of New Zealand that started this. And unfortunately, the combination of deflation coming out of Asia and the Western infatuation with headline inflation targeting created a rather disastrous result. Because if your import prices were falling 2 or 3% a year, think of the warehouse effect in a sense, getting stuff from China, selling it cheaply, it becomes quite hard for the central banks to actually hit their inflation targets unless they create 4 or 5, sometimes 6% rates of inflation in the non-traded parts of their economy. And obviously property is the ultimate non-traded good and the key to costs really in so much of what we do. So Asia exporting deflation, the West running inflation targets meant that we had to have inflation in property prices, in service prices, think restaurants, haircuts. I've just got a quote from a plumber in Queenstown, which has made my eyes water for a relatively minor bit of work. And this biases the economies. certainly in the West, we've seen resources drawn into those non-traded goods sectors, those services, and obviously this is topical now with people talking about inflation in those sectors. But that rise in non-traded goods prices relative to traded goods prices, or services relative to goods, is what economists call an appreciation of the internal real exchange rate. Now, that should appreciate over time. And if you follow the productivity model for the US, you get this sort of appreciation. But actually, because of these distortions, in the US, we've got a massively overvalued real exchange rate. It's probably worse in New Zealand, certainly is in Australia, the UK. Pretty much most Western economies have this problem. And that's biased our development into the service sectors where you've got relatively low productivity growth, which limits trend growth in the economy, high income inequality. Services carry a whole range of different incomes, and not too much of a middle ground, actually. So it's the income inequality, high property prices, low housing affordability. Many of the ills that affect society today can be traced to this. Now, it's been 25 years in the making. And I think we're probably stretching what's possible with this now. It doesn't seem that real exchange rates can really appreciate that much further, but they've done their damage. They've certainly done their damage to growth. And of course, governments over the last 10, 20 years have wanted growth. So they've pulled out all the stops to try and generate that. Initially, it was very low interest rates in the 2000s, credit booms, property price booms, everything that led us to the global financial crisis and then the bust. For most countries, since the GFC, it's been to use fiscal policy. And if we look at cyclically adjusted budget balances in the major regions, you can see this ratcheting up after the GFC and then another ratcheting up after the pandemic, a real sort of fiscal mission creep, as it were. The US particularly bad, but by no means alone. Now, where the US is different is almost uniquely, it's managed to keep its private sector credit boom alive as well. Now, it's not necessarily in the data because most of it now occurs through private credit channels, through private equity, through private credit, through venture credit, and that whole rather mysterious universe of stuff that's grown up over the last 10 years, really. And actually, it's grown so rapidly that it's left the statisticians behind. So one of the problems in analyzing the private credit channels is there is no macro data because the Federal Reserve, and I've spoken to them about this, don't have the resources, don't have the budget to monitor it yet. And as one of them rather candidly said, we'll only get the money to look at it when it blows up and Congress wants us to do something about it. And that's very much where we are, I think, at the moment. There is a private sector credit boom in the US. It's hidden in the balancing items and statistical errors because they haven't got the data series in place yet to monitor it. But that's why the US is so seemingly exceptional, why it's standing apart from others. It has these huge cyclically adjusted budget deficits and a private credit boom. And that's why the US seems to be outperforming. Now, the problem for the US budget deficit, and I think this is a problem that we saw over the new year, and we'll see again probably later this year, is the budget deficit is much larger than the amount that households save. The government is trying to borrow more than the household sector saves, and that has a sort of whiff of impossibility about it. It's happened before, but on each time it's happened before, we've had to use quantitative easing. The shaded areas here in blue are quantitative easing. The green shaded areas are quantitative easing before we called it quantitative easing, but it amounted to the same thing. So every time Uncle Sam has tried to borrow more than households have wanted to save, or indeed the West has wanted, Western governments have borrowed more than households have wanted to save, we've had to resort to QE. Because if you don't, you've got to find more savings from somewhere else. You've got to ask the corporate sector to not do capital spending and acquire treasury bonds. You've got to attract foreign savings or force households to save more. All of that involves higher real interest rates. Higher real interest rates, of course, lower bond prices, a lot of damage to the system, and economic slowdown. The other option is to adopt fiscal austerity, and clearly we're seeing talk of that in places like France and the US, although the talk seems to be relatively cheap. We're not actually seeing much action. So we are still in a world that was reliant on quantitative easing. And if we look at QE on a monthly basis in the major economies. Here's the pandemic, lots of QE. We did have quantitative tightening in 2022, and of course, markets sold off. But since then, we've been toing and froing QE, QT, sort of almost alternate months. And the markets are reacting almost on a weekly basis now to whether the public sector is generating liquidity through this QE type approach, or whether we're quantitative tightening and then real yields rise. I mean, certainly in the 8 weeks or so since the election, you could follow the ups and downs in bond yields almost entirely on this sort of maths. And that's the world I think we're going to occupy for the rest of the year. It's going to be trying to balance how much governments are trying to borrow versus how much liquidity is being generated in the banks, in the public debt markets. And that's really what we've got to monitor this year. Making the situation a little harder is there is still residual inflation around. If we look at capacity utilization in the US domestic economy, it's still above trend. There is still pressure in the non-traded goods sectors. We're seeing that in New Zealand, certainly in Australia, even in the UK. Japan doesn't even have spare capacity in its domestic economy yet. So there's still that sort of background of inflation. I don't think that's the primary driver of debt markets at the moment. I think it's much more what we were looking at in the chart above, this imbalance between what governments are trying to borrow and the resources available to them from saving. That's, I think, the biggest factor for bond markets. But we've also got this in the background, little residual inflation in the domestic economies, which influence the Federal Reserve this week with their policy decisions. Now, if bonds sell off, I think it has a number of impacts on the economy. The first one, and the most obvious, is just the normal one. Interest expense goes up relative to income growth, all the usual stuff you'd expect from higher rates. People want to borrow less, people forego consumption, companies postpone investment, and the economy tends to slow down. But there are other factors that I think are more unique in the world that we're occupying in today. For a start, if we look at the yield on US equities, which is here in blue, and I'm defining the yield as dividend payments plus stock buybacks plus employee stock option payouts, for the first time now since 2007 and really since 9/11. But for the first time in a long time, we now have bond yields above equity yields. The cash yield on the bond market is higher than the cash yield on the equity market. That suggests a fragility for asset prices, which of course we saw over Christmas and New Year. If bond yields were to spike higher, this I think would become a big problem for the equity market. On this metric, it's the first time equities have really been expensive for really since 2007. Here is the other part though, and I think this is the most significant part for the economy. Those private credit channels that I talked about that are sustaining the US credit boom, they're generally financed ultimately through the wholesale money markets, and the wholesale money markets work on collateral. And traditionally, the primary asset that's used as collateral is treasury bonds. So if we have a sell-off in treasury bonds, the stock of eligible collateral falls, and that becomes a binding, almost physical constraint on how much people can borrow. And you look at the private credit funds, they're 2, 3, sometimes 6 times geared. Private equity is 1.3 times geared on average. The companies in the portfolios tend to be geared. There's leverage on leverage on leverage, much of which is reliant on the value of collateral. So if we see the private sector, or if you see the public sector issue too much debt, crowd out the private sector, real interest rates rise, bond prices fall, the credit boom would end, and the economy, I think, would slow down quite sharply, particularly because when we look at the US corporate sector, it's now cash flow negative again. Now, this is an aggregate figure. There's a great study by the University of Chicago that looks at the concentration of corporate cash flow, corporate assets, and finds that the greatest level of concentration in 100 years, which of course is confirmed by the behavior of the equity market over the last year or so. But if you take out the top 20 cash generative companies from the data, then you find that the US corporate sector is at least as cash flow negative as it was at the end of the 90s. So if we had a disruption to the credit system, particularly because of drying up in the value of collateral, then the corporate sector would be starved of funds. We'd have to see a slowdown in investment and a big turn downwards in the labor market. Certainly, US companies, I don't think, have the profits to continue regardless. Although we're publishing good profit data, if we reconcile the balance sheet with the P&L, the profits are being reported, but they're not being reflected in assets in the corporate sector. And that suggests to me that maybe the profit data has been overstated. That often happens during periods of financial innovation. Certainly happened in the late 90s, the mid 80s, and before the GFC. There was a lot of borrowing the statisticians didn't capture because they didn't have the resources. So somehow the borrowing got called revenue and ended up in the P&L. Often you then get big revisions when the thing finally goes bust and the data is available, which is certainly what happened in the NASDAQ bubble. I think there's some of that going on as well. So if we were to see a sell-off in the debt markets, I think the economy would slow down, the equity market would be vulnerable, and actually we'd probably find ourselves in quite significant recession quite quickly. So that's one credit boom. The other credit boom is China. All that corporate borrowing has meant that the Chinese corporate sector is now carrying a debt burden of a couple of 100% of China's GDP. Now, I think a lot of people are very optimistic on China at the moment. There's supposedly been this big fiscal easing, and a lot of the more technical commentary is talking about a rise in the narrow measures of China's money supply. But when we look at this, we find that the growth in China's money supply is all in physical cash, large denomination notes, in a society that doesn't really use cash. This is telling you that people are taking their money out of the banks because they fear for the safety of the bank, and they are stuffing the mattresses. There is a shortage of safes. Now, if people are taking their money out of the banks, that of course implies that the banks have less money available to lend. So we're seeing bank credit growth crash in China. And now the amount of credit being advanced by China's banks is less than the money required by the corporate sector to fund its cash flow deficit. So you've got another round of austerity occurring in the Chinese corporate sector, which is why the economic data has turned down again in China over the last few weeks. In theory, China could inflate. It could press the quantitative easing button. It could run a budget deficit of 15, 20% of GDP for the next 2 or 3 years, which is what the West did in response to the GFC. But I don't think Beijing will do that, much too worried about the inflationary consequences. Traditionally, regime changes happened in China if you have an outbreak of inflation. The Chinese Communist Party will be aware of that. So I think they'll be reluctant to go full-blown QE. So it seems to me that China's boom is also slowing. So if we think of what's dominated the world for the last 10, 20 years, this big credit boom in China providing supply, and a big credit boom in the US and the West, initially private sector, now generally public sector, except in the US where it's both. But that provided the demand. So these twin cycles coexisted, and we had that sort of happy world to an extent. Both of those credit booms, I think, are now under threat. The Chinese one, I think, is definitely ending. The US one, or the Western one, would definitely end if real yields were to rise. And that would affect the emerging markets, affects Europe. The French population hasn't had to fund their own budget deficit for 20 years. They've been reliant on either quantitative easing in red or foreign inflows. All of that dries up in a world of higher yields. And emerging market liquidity is just a function of Western quantitative easing now. So in a sense, we're in a very correlated world. Everything really comes down, I think, this year to is the China slowdown enough of a deflationary effect to keep bond yields down, or does this wayward borrowing by US and other governments force real yields higher? That's the ultimate question. What happens next? Well, we can monitor on a weekly basis the amount of credit provided by the financial system, by the banks to the US government. Is QE or QT occurring? Over Christmas, it was QT. First couple of weeks of January, it was QE. Last week, it was QT. We can monitor this. And that these liquidity injections are then reflected in whether the financial system gets credit, whether we get leverage in the markets. So the markets really are hypersensitive to this. Um, for what it's worth, we think there's probably about $600 billion left in the US government's fiscal resources that they can release into the economy. That takes them to June. There's enough money in the US government's bank accounts and in the Federal Reserve's reverse repo facility. That means we can probably get through to the middle part of the year before we start having to do significant amounts of debt issuance that might stress the bond markets. So unless we go back to full-blown QE, we can expect some increase in yields towards the back end of the first half of the year, which I think will be very detrimental to growth, very detrimental to equity prices, unless the US government can come up with some new way of monetizing the deficit. Now, that's not impossible, but I think it gives us this timeline. So unless monetary conditions ease in the near term, particularly in a quantity sense, markets are very vulnerable, strong dollar over the next 6 months. We need a fiscal tightening, monetary easing, but that's very difficult to achieve. Ultimately, and for the second half of the year, I think we do go back to a global quantitative easing. Question is, does it occur before or after a crash in markets? Now, going back to quantitative easing at a time when the populations of the world are generally distrusting of their leaders, I think rather cynical about policymakers, if we start pumping liquidity back into the system, I think that will result in inflation. So my sort of medium to longer term forecast is that we see 26, 27, 28, perhaps even into 2030 sustained inflation, quite poisonous for bond markets, really something of a repeat of the late 70s. But this year is a difficult year. Do we see QE before or after the crash? I'd say a 60, 70% probability is that we do get a rise in bond yields, that markets are very vulnerable in the second quarter to that, and then we get the policy response and the buying opportunity in markets. But there is a little possible outcome whereby the US Treasury could harness some of the interest in the cryptocurrencies as a funding tool and prevent that rise in bond yields, in which case the bubble continues. The US credit boom can continue. We don't really slow down. Equities do all right for a while, but that still has that inflationary consequence longer term. So this is going to be, I think, a tough year to actually time correctly. Longer term, I think we're following the 70s narrative that we have a spike in inflation around a crisis. So OPEC 1 in 73 or the pandemic, inflation and bond yields came down, but a recession, policymakers ease, and we get the second peak in inflation 3 or 4 years later. That was the damaging one to bonds. And I think that's where we are for the latter part of the 2020s. Quite what happens in this middle, this is clearly unprecedented in terms of some of the political characters we have. Do we have a funding event, a crash, and then, or at least some drawdown in equities and then kind of slowdown, and then a big policy that gives you that buying opportunity? Or do we skip that bit and we find that the Trump administration finds a way to keep monetizing those deficits? That's an open question. I think it's about a 60-40 on either of those two scenarios. Interestingly, and as a final thought, I think all this monetary instability is going to encourage more emerging markets and other countries to pay less attention to their currencies and more attention to their own domestic needs. Emerging markets will want to break this correlation between their liquidity and Western liquidity, in a sense, do what Japan did in 1976. And I'm very conscious that my predecessor in my first job had been the economist that presented to his investment committee in the mid-70s saying, Japan's going to do this right. They're going to control inflation, they're going to generate productivity growth, and we should invest there. Now, half the investment committee wanted to stick with America and half were interested in what John was saying. The company actually split in two. The argument got so bad. The guys that followed Japan outperformed their US counterparts by 400% in dollar terms over the next 10 years. And I think some of the emerging markets will break from this Western madness and become the new hard currencies. And actually, emerging markets which haven't offered much diversification really have just been beta plays on global Western liquidity, are going to become, say, I think the hard currencies, proper diversifiers. If they can get the productivity growth and have the monetary credibility, then they could emulate Japan from 75 to 85. Some of them will fail. I think some will try it and have too much political interference. But the ones that do it right, I think will have a genuine place in portfolios and actually offer some growth and some diversification, which the EM really haven't done for a long time. So that's the presentation. We're going to stop there because I'm sure Stuart will be worried about timing. Any questions?
Yep, I've got a couple of questions for you. Thanks, Andrew. Really, really interesting. And please spend hard in down in Queenstown with your plumber. We appreciate that. So a question that's going to go to you and to Ian is just about US debt and perhaps its debt to GDP. So if you could just talk a bit about the sustainability or whether there will eventually be a problem with US debt levels, and obviously we've got a Trump 2.0. So just and if you can compress that answer a bit, I've got a second one for you on Bitcoin.
Okay, well, I actually run the two together.
Okay.
The debt level, I don't think levels matter too much. It's the interest expense relative to the income growth, or it's that chart I showed earlier of household savings, a flow versus the flow of government borrowing. So I'm much more interested in the flows than the stocks. And I think mid-year, we will have a flow problem that will drive real interest rates up. Then debt sustainability is questioned, not just in the public sector, but the private sector, and a number of things go wrong. So the question is then, how do you stop that? And it could be a lot of fiscal tightening, and we're sort of seeing haphazard attempts at that. But in general, you tend to be disappointed when you try that. It doesn't happen in a short period of time. So the question that I think really is for this year, we will have, or the issue is we will have a debt sustainability problem unless we find a way to monetize more of the budget deficit to prevent that rise in real yields that will be so destructive. Now, at the moment, we're seeing this boom in crypto, and the capitalization of these markets is exploding. Now, the sector of this that matters are the stable coins, which I don't think are money, but they're getting closer towards money. They're getting more popular. And traditionally, they hold, because there's a stable, I don't know how much people know about the stable coins, but they're supposed to keep their value stable against some yardstick, normally the US dollar. And as a result of that, the people that manage these things have to hold a lot of dollar assets. And traditionally, half, 3/4 of the assets they hold are treasury bills, US treasury bills. So the bigger the stable coin market becomes, the greater the demand for treasury bills from that sector. Now, in the past, it's been 10, 20, up to about $100 billion, significant but not earth-shattering. But now these things are getting into the $1 trillion of market capitalization. So you could potentially see half, 3/4, maybe even a whole $1 trillion of demand for treasury bills come out of that crypto universe, which would go a long way to getting the US through the rest of the fiscal year. So there is a real incentive for the Treasury to propagate, to encourage those sectors. And of course, we know that some of the people surrounding Donald Trump have a vested interest in this as well. So I think you work on the assumption that we could well see a spike in yields and questions over US debt sustainability, unless this crypto boom becomes so significant that it has a byproduct effect of funding the deficit. Now, it sounds a bit far-fetched and a bit weird. There are historical precedents. If anybody's particularly keen, Googling John Law from the early 18th century and the formation of the French National Bank and the Mississippi bubble and funding a bankrupt French government offer, I think, some interesting insights into how the crypto markets could end up funding Uncle Sam. So that's one to keep an. It's real left field stuff, but we need to keep an eye on it, because if it does work, you don't get that rise in yields. The US sails on regardless, ultimately with inflationary consequences, but it would, I think, radically change the world that many people are expecting, which is to have a funding crisis some point this year.
Excellent. Always good to leave us with a bit of a Google follow-up to do. So thank you very much for your update, Andrew, and look forward to seeing you in person very soon. Thanks.
See you soon. Thanks a lot. Bye.
Excellent. All right, with that scene setter, we're going to go to our own Ian Bellew. And yeah, interesting points there. You heard the questions, so you can work those answers in as you go along, if you like. I mean, I guess the other thing that's really interesting is we're a couple of weeks away from the first Reserve Bank announcement and updated data. So fire away. And again, if you've got questions, shoot them through online, and I'll endeavour to squeeze them in and talking to Ian. Ian, it's over to you.
Yes, Stu, and happy Lunar New Year, everyone. I'm a bit more positive on the bond outlook than Andrew. That's probably a bit more NZ specific. You'll see actually over my shoulder waving in good fortune for 2025. I have Prosperity Cat. But I thought I'd start off with a little bit of a recap of what is our style of investment or investment horizon. And I guess that's relevant to where I'm heading with the points, how I see things developing this year. But we're medium-term investors, and that's because we believe it gives us a better chance of performing well over the longer term. And also it allows us to be more in tune with economic and business and credit cycles rather than short-term investing horizon. And we try and avoid bets that are too time sensitive or precise, and that allows us more margin for error. And also, we believe that medium-term focusing makes it sometimes, easier to face up to your mistakes and learn from than an ultra long-term investment horizon. But I'll start off with a recap of where we're starting from. So 2024 was a pleasing year for NZ bond returns, not so much in the US, but the Nico bond fund returned around about 6.6% for the year, and the corporate bond fund just under 7.7%. Those returns were somewhat muted in the last quarter of 2024, and you'll remember through the holiday period, right up to mid-Jan, markets sort of worked themselves up to a point of quite some angst. So early in 2024, the market had been almost desperate for rate cuts. Central banks belatedly came to the party. But then through the holiday period, particularly driven by, I guess, stronger, more robust growth and employment outcomes in the US, the market quickly began to unwind and take out the expectations for rate cuts. So before US CPI came out, the markets were sort of pretty much perched on a knife edge. People were expecting US long bonds to go to 5% or higher. But I think US CPI coming out a little bit lower than expected reminded the markets that the glass is half full rather than half empty, and we've seen local bond yields down around 25 to 30 basis points from their January highs. So month-to-date returns for the new year are going to be round about flat at this stage, with bonds only slightly higher than when they started the month. So when we look at New Zealand and I guess the Fed, I really see it as a case of comparing I guess apples and lemons. The Fed is essentially in no hurry. They have no need to cut interest rates in a rush. Growth is still strong, albeit slowing. They've got disinflation and at a slower level, and also unemployment is robust. But then in contrast, when you look at New Zealand, I guess expectations have bounced back, but current activity is still very woeful, and that's proved a real hurdle. Even though confidence has bounced back, consumers are reluctant to spend money, and businesses are still reluctant to invest. And some part of that it probably is that mortgage rates around 5.5. got a record amount of people that are on floating or have their mortgages fixed inside 6 months. So people are, I guess hanging up for rates closer to 5%. Maybe we'll see mortgage rates come down, another 50 basis points as we continue the easing cycle. And also businesses, they're not really going to invest unless they think they can return a satisfactory return from that investment. So we need consumers to rebound before we see that really turning around. Also, another thing is in New Zealand, the rest of the world, yield curves are very, very steep. So you've almost got the front and the back of the yield curve saying different things. Of course, short-term interest rates are heavily dominated by local economic outcomes, which in New Zealand have been very weak with little to no growth. And the back end of New Zealand has been, I guess, risen quite a lot, influenced by, held up by higher US long-term rates as well. So, the New Zealand 10-year bond today is around about 4.5%. Our longer bonds sit around about 5% in New Zealand. So, that 5% isn't a line in the sand, but I think it is a psychological level. When you can get a 5% return on a government bond with very low risk, it does look like a reasonable return. Particularly when I guess equity prices are predicated on high growth going forward. So there is a lot of expectation burden in the equity markets for them to keep performing. Where do we see value? I see the steep yield curve. And again, look, I think the steep yield curve, why is it high? Andrew said, we're still having, inflation is slowing, but it's still sticky. So, that's pricing in a higher term premium. So that's pricing in inflation, sticky around that sort of 2% level, probably not dropping back to that 1% level because we're just not seeing, I guess, that benefit of lower tradable inflation through globalization like we have over the last decade. And also supply. So, that's very much a normal driver of markets. If you have more supply, then the price needs to adjust to where buyers see value again. Also, in the New Zealand corporate market, credit margins are around about fair. Last year, they were arguably getting tight with a lack of supply, but we did see quite a few banks and corporates come to the market in the second half of the year. So it has been healthy that credit margins have recovered, and that helps support returns going forward. When you get a gradual widening in credit margins, it's not harmful for the portfolios at all. There's a few names that are a little bit, I think we offer good value. So that's the property REITs, perhaps MetLife, KPG, some of those unrated and triple B assets in that sector alone offer reasonable value, but we think the rest of the triple B sector is relatively tight in margin compared to A-rated assets, like banks. So there's not really a lot of value for going down the credit curve, but you do get value for going out longer in maturity, given the shape of the yield curve. In the RBNZ, like everyone else, their expectations are that we will get a 50 basis point cut in Feb, and then as they get closer to their target, Paul Conway, the chief economist for the RBNZ, was out last week saying they see long run neutral somewhere from 2.5% to 3.5%. So arguably, we could still have a reasonable amount to go, but as they get closer to the end point, obviously we'd expect the rate cuts to become smaller in size, and there may be some pauses along the way. So wait to see how the economic data develops. Also, one thing that Reserve Bank has been talking about a lot is really some of the structural issues that New Zealand faces. So that's lack of productivity growth. So if you don't have productivity growth, unfortunately, your ability to grow with low inflation, the runway is much more constrained, because as soon as you use up that spare capacity, then growth becomes inflationary. And the Reserve Bank thinks that we can grow somewhere from 2 to 2.5% before it becomes an inflationary, which is fairly modest. Looking at some of the key drivers of the market over 2025. Look, I think there's a lot of uncertainty out there that's not necessarily factored into analyst forecasts at this stage. We've got Trump 2.0. The guy previously has shown that he's more likely to use a sledgehammer Also, start some immigration. We've got a weaker China. As I said, a stronger US I think is holding up the long end of our bonds at the moment. Most people expect the US to achieve a soft landing, but that could turn. So most major economies, have got fairly average to weak growth and declining inflation. That's, of course, is ex the US. The other day we had Australian CPI out that actually came in lower than expected. Their CPI is around about 1% higher than us, so around about 3.3, but they're more optimistic that they'll have rate cuts early in the year now too. But most developed markets have had this problem with persistent services inflation and largely relied on lower tradables to achieve, I guess, an aggregate outcome of inflation that's in the band, which for most economies is around about that 2%. And New Zealand's inflation is sitting at 2.2 at the moment. We expect later in this year, tradables might be a little bit higher with higher oil prices as well, but there's nothing that should really throw the Reserve Bank off its continuing path of interest rate cuts. And some other major considerations for markets, I think, is, I said, through the holiday period going to January, the markets had almost been bipolar, switching from being happy about interest rate cuts to almost pricing them out. High equity valuations, and also we've got this, growing debt supply, and in turn, people talk about bond vigilantism. So bond investors are becoming, basically they want higher yields or a cheaper price to buy government bonds. And you've seen it very much reflected in the New Zealand government bonds. The risk-free rate is trading over the swap rate. So New Zealand government bonds have been trading about 60 basis points over swap, which is very unusual, but that could persist for quite some time given the high and increasing supply. Also, we've got, said about mortgage rates are still high. So if we do see mortgage rates fall closer to that 5%, I think we'll see an increase in fixing. And as banks hedge themselves, as more clients fix out 2 or 3 years, effectively what they do is they pay swap. So what that does is that'll actually drive those 2 and 3 year rates up. Even though the Reserve Bank is cutting, we may see that part of the yield curve move higher, but I don't think that'll necessarily happen until later in the year. And then in May, of course, we've got the budget. So you've seen a lot more political rhetoric around about supporting and promoting growth. As I said before, a lot of the heavy lifting and stimulating the New Zealand economy falls to monetary policy alone because the government has been relatively constrained from a fiscal perspective. So I guess outside of, essentially what we expect is that we'll see some freeing up, like in the terms of mining, etc., and maybe reduction of red tape is probably where the government can make more headways rather than necessarily borrowing more and having more money to spend. And upcoming issuance, ANZ hasn't issued a New Zealand bond for quite some time, over 6 years, but they're going to return to the New Zealand market next week, issuing a 5-year bond. We think a fair margin for that will be somewhere around 90 to 95 basis points. Underlying swap is 3.7%. So you buy a 5-year bank bond around about 4.6%. And we've also got a syndication of government 2035s coming up as well. The government's got around about 6.8 billion to raise before June, but we'll expect they'll try and front load that in February's tender. And we also think people will see greater value in the long end of the yield curve. As I said, those long bond rates around 5%, and as the front end goes lower, people are always looking to where they can achieve a more reliable return. So we think we will see some support for the longer bonds as we get further through the year. And I'll just leave it there. I'm up to time.
Hey, thanks, Ian. That's really great. You've answered a bunch of questions I had in my own mind, and in particular, it's interesting if the viewers or listeners haven't seen the Paul Conway commentary. It is quite interesting, and I think you can also sort of see what you were talking about, Ian, in terms of the flatness of the 3, 4, 5 year mortgage rates, and thanks for the explanation about the risk-free rate over the swap rate and how that the implications for the bank from that. I thought that was right on the money, unintended.
And also in response to your question about US debt, I just wrote down some bullet points, underlined it 3 times, as confidence and also liquidity. So, the US Treasuries are probably the only market where you can, liquidate, 50 billion of Treasuries without unduly moving the market. And of course, that growth versus debt ratio and servicing, are the other bullet points I wrote down.
Perfect. That's great. Thank you very much. We're going to jump over to MDC, Michael de Cesare. So looking forward to hearing from you, Michael. So the floor is yours. And again, if you've got some questions for Equity Land, then fire away. Thanks. It's all yours, Michael.
Good morning, everyone. I hope you've had a great week so far, and it's good to be presenting this equity market update for you. I thought I'd talk to disruption facing a few companies in our market, as it's timely and should be helpful before touching on the market more generally to finish. On this first slide, I've got a couple of examples of disruption at the top there, followed by a case study. But before we get into that, I'd suggest that disruption risk from an investor's point of view is believed to be when the status quo may potentially change, leading to a significant and rapid destruction of value or indeed a creation of value. And because the market's forward-looking, we try to price future disruption risk, and that's what you'd see in the share price. However, historically, the market has struggled to do this well and consistently. If I start at the image at the top left, the US president's tariffs, I know a lot of people would have heard about them. In particular, at Davos recently, he not only reaffirmed a 25% tariff for Mexico, he put a date on it being the start of February, which did lead to the market getting some jitters. Also, he's proposed a 10% universal tariff. Presumably, New Zealand would fall under that. Very interesting for our largest listed company, Fisher & Paykel Healthcare. What you can see in the image there is their 2 largest manufacturing sites, Mexico and New Zealand. So in New Zealand, they produce just over 50% of volume, and in Mexico, a bit over 40% of volume. Now, the real issue being Fisher & Paykel generate over half of their sales revenue from the US. Therefore, a potential problem here. As a result, we'd expect that a 25% tariff on Mexico and 10% on New Zealand would have a material impact on Fisher & Paykel should it be enacted. However, the share price has not really reacted too much, has been testing all-time highs. Following the Davos comment and the actual date, the stock is down 5%, but nevertheless, it's been trading really well. It would be right for us to also add that we would expect Fisher & Paykel to be able to mitigate some of the financial implications over the medium term. They'd reconfigure their supply chain, potentially supplying more from New Zealand to the US and Mexico to the rest of the world. It's obviously not as simple as that, but that would help them in the medium term. In addition, they do have some pricing power, which over time they could push through to the end consumer, also mitigating some of the effect. Nevertheless, it would be a pretty difficult situation in the near term, at least. If we move to the image on the right, this is one where disruption risk is arguably priced in too much, in our opinion. You may have heard of DeepSeek recently, or Chinese AI causing a stir in the market. DeepSeek isn't something too new. Bloomberg had it in its top 10 list of AI models about a year ago. It's essentially a large language model, similar in functionality or outcomes, shall I say, to ChatGPT. And whilst that caused a stir, the real issue was the cost in which they said they were able to build it. Just a fraction of the money invested by these large tech giants, which means at the worst case scenario, and if you believe the numbers, which should of course be taken with a large pinch of salt, that the investment from the tech firms may have been misplaced, that their competitive advantage is much slimmer than expected, barriers to entry much lower, and their share of the long-term profit pool much smaller. However, I'm not necessarily, while I do have sympathy with that view, I do feel like 70 to 80% of the value destruction so far has been more due to sensationalized media coverage, comparing it to the Sputnik moment in the 1950s, which it clearly isn't, in my view. Also, the fact that it's such a crowded trade with lots of retail investors in there, and also just animal spirits with the herd mentality, leaving only 20 to 30% of the moves probably due to a consideration of the actual fundamentals. What gives me a bit of confidence about that is, for anyone who's been listening, China's been saying for over a decade that they want to dominate, they want to lead in future industries, very much including AI, very much including robotics and quantum computing. Therefore, it should not be a surprise. And for those surprised, should probably suggest that that's a little naive on their part. The timing's not a coincidence after the US's Stargate announcement. Probably just a reminder to the US that don't think you'll be able to run away with this on your own. We're still here. But arguably, from my perspective, the most important part is that China has not diverted from their usual MO, the way they've done things in the past, which is to use replication as opposed to invention. So they are and have been fast followers with little regard for IP, and without the real invention, it's hard to see them being able to leapfrog the US and lead in this space. Now, why I think that is when you look at the model more specifically, is able to operate on significantly less computational power simply because it mimics the answers of larger language models already built by the US. So just think about that. So it's like copying the answers rather than knowing the answer, rather than knowing the library as such. Therefore, it can never lead and would always follow. I'm not saying that invention could not emerge in the future, but for now, it's the same Chinese approach. Also, that does not mean to say there wouldn't be a place in the market for this. I'd see it more of a practical, cost-effective alternative for highly specialized situations and potentially for smaller firms to use. Larger firms will always want the cutting edge. For some large US firms like Google, AI is an existential threat. Of course, they can't let someone else build a better search engine than themselves. So there's a lot of reasons why the investment from the US tech firms will continue to be deployed. If we bring it back to Australia and New Zealand, the companies affected here in New Zealand would be Infratil, to a much lesser degree Spark over in Australia, NextDC, and Goodman Group. However, Australia and New Zealand is largely an inference market where the reasoning takes place. It's never been a training market where the heavy lifting occurs. That's almost entirely done in the US. So if should any disruption occur, it would be much less likely to impact us down here. The contracts are 15 years plus. They're locked in and legally bulletproof. So while not dismissing it, we're going to continue to assess new information as it comes. Views are not anchored, but at this point, it does feel overdone. Moving to the chart at the bottom there, I just wanted to highlight the opportunities that present themselves from disruption risk. So as you've gathered, the market struggles to price it efficiently. And therefore, when there's great inefficiency, there's great opportunity for alpha generation. So last year, the emergence of GLP-1s, which many of you would have heard about, potentially more as their brand names, Wegovy, Ozempic, which offered patients the ability to lose 20-25% of their body weight. So the first circle you can see there at the chart at the bottom is when the market attempts to price this GLP-1 risk in the sleep apnea market, given obesity has long been linked to sleep apnea. For ResMed, the leader in the industry and one of the highest quality companies in Australia, it led to a 40% decline in 2 months. We observed this occur. We employed our fundamental research investment approach, did a deep dive on the medicine to get a superior understanding of the implications. We did take our time, and the second red circle there is when we established the position, April 2024. We took our confidence via valuation scenarios where even our most realistic disrupted scenario suggested a fair value significantly above the market price. And the position has now given us over 40% from April last year. So that's an example of active management and our style at work. If we move to the next slide quickly, please. I know it's been a while since the last equity update, so the chart on the left is just summarizing how the year ended up, very much a second half story, with the catalyst being the RBNZ's dovish turn. We ended up with a 12.2% return for the year, entirely made in the second half as such. Month to date, it's not unexpected that after such a large return in a short period of time, the market will take a breather. That is what has happened. We're down about 1.3%. At the bottom there, a few weak trading updates have curbed some enthusiasm for consumer-facing and cyclical stocks, while Infratil there at the bottom has been caught up in the AI sentiment that we discussed earlier. At the top, the banks have done really well. The 3 banks in our benchmark, ANZ, Westpac and Heartland, while Sky TV continues to be a recipient of takeover speculation. And SCL, their Scales, is an exporter that earns a lot of its money in US dollars and a big beneficiary of the weaker NZ dollar. If we move to the next slide, please. I'll quickly summarize some of the main new news that's emerged in January. As mentioned, a few negative updates from the likes of Kathmandu, Briscoes, Convita, all missing market expectations, albeit a common thread would be some tentative signs of green shoots at the back end of their trading periods. Fonterra is a good news story. Excuse me. The sector's GDT auction price, collection volume and currency could lead to up to an additional 4 billion for the dairy sector this year. And moving over to M&A and regulation, excuse me, the regulator has kicked the can on Contact's attempted acquisition of Manawa Energy until March. So that's probably worth noting. And at the bottom there, a few leadership changes. And just to finish on the final slide. So I think what this discussion of disruption risk reminded me of is the importance of having an active manager who employs a fundamental research-driven process. For example, passive funds, which simply replicate an index, would would hold would be exposed to a negative disruption risk and hold the index weight and go down with the ship, whilst a positive disruption story that would still just hold index weight and not try to take advantage of it. Active management and our process is something we remain loyal to. We've employed for a long time. It works. We've just had for my SRI equity fund, but our other funds are similar, just had a 5th consecutive year of material outperformance of the benchmark. And as you can see, over the short, medium, and long term, has delivered outperformance. Excuse me, losing my voice. Given the time here, I'll probably just end with that and the confidence that our process will continue to deliver outperformance over the medium term. The market so far is up. The funds are slightly above the market month to date, which has been quite volatile, but so far so good. Back to you, Stu.
Thanks very much, Michael. Great presentation, great update. I hope the Chinese weren't listening to what you had to say. Just to close it out, I think it is a really good environment for investors just now. The point that Ian made about getting a 4.5% to 5% return out of bonds for a conservative investor and building a portfolio from there, and 10 to 12% return out of equities in a strong period of both market performance and outperformance in global shares, hopefully should put all of your clients and yourselves in good positions for the remainder of the year. As always, feedback is welcome, and actually just reminding you again about Summit, and actually one thing that'll be a bit different in Summit is there's going to be a couple of companies presenting, two that were touched on today, one being Contact and the other being Infratil. So a slightly different format, which is quite topical given the points that Michael just made. Enjoy another short week coming next week, and we will see you soon. Thank you very much again for your support. Goodbye.